180 and when we're at that speed down to 2500.
Yep, point 4 heavy, reduce speed to 180.
BlackBox.
Hey, so my guest today over here is Bobby Ashburner of Coastal Mortgage.
Coastal Town Mortgage.
Coastal Town Mortgage. Thanks for correcting me there. Bobby's been a friend of mine for a number of years. He's been in the mortgage business since 1996. And as you know, here in KP's BlackBox, what's important to us is having a conversation with everything that deals from oxygen to money. The two most important things in life, in my opinion, that are necessary to live. Try to live a day without some oxygen. Try to live a day without some money. And let me know how that works for you. And if you find successful opportunities in living without oxygen and money, I want to know about it, and so do our guests. But here today, we're going to take the black box dive into all things mortgages. And off camera, Bobby and I were having this conversation about a lot of times consumers, mortgage prospects have questions that maybe they're just a little too afraid to ask. And so what we want to do in BlackBox is just really deep dive those questions, Bobby, and really get down to the nitty gritty of how a mortgage works, why we have mortgages to begin with, and then how you can use that mortgage in your overall financial strategy. So, man, thanks for being here today. I'm really happy to have this opportunity to talk to you and to educate our audience about all things mortgages. So how are you doing, number one?
I'm doing well, thank you. Thanks for having me.
Absolutely. I mean, we're in this environment as we're recording this. We're still in the COVID-19 time. And here in Virginia, Friday, what's the date today, guys?
Today's the 15th.
15th. This is kind of like our grand opening, right?
It is.
The state is saying, hey, we're going to tiptoe the waters of trying to get back to normal. And you were telling me off camera that today's your first workout.
First day back to the gym. Waring's is open, and we're looking forward
Waring's Gym. Now, that's a name that goes back decades.
Decades.
Yeah. Shout out to Waring's Gym and all the folks over there. So you're going to start your routine back in the gym today.
Today is the Friday Faithful, 4:30 in the afternoon.
Friday Faithful. So is that a group of people?
It's a group of people that get together every Friday at 4:30, from 4:30 to 5:30.
Wow. You know, I'm starting to get back into working out, and you can't see it here on camera, but I've got this little TENS machine. Is that the TENS?
The TENS
unit.
What
It's called.
Yeah.
So I've got this little thing on my back, and like every 3 seconds it vibrates. Mm-hmm. And as I was putting it on earlier, I shocked the living out of myself and let out a little girly scream. So if that happens in the middle of our video podcast today, you'll see it and you'll get to hear it. But hey, down the business. So you started in the mortgage business in 1996.
Yeah.
Tell me about it. How'd you get your start?
A friend pulled me over to the side from the gym and said, hey.
Waring's Gym?
Actually, it was a gym that's no longer in business. It's a place called Hard Bodies.
Hard Bodies.
At Hilltop.
This is not a porn show, Bobby. Come on.
No.
Sorry, I take it down quick.
No, it was the only gym in town that was a IPFA transfer. So my gym membership
That's
from
the Bodybuilding Federation, right?
San Diego transferred to here. So my $14 a month in San Diego was paying my gym memberships in Virginia Beach. So
okay,
that's why that gym.
So you were working out with a buddy, and he says, "Hey, try this mortgage thing out."
Yeah, you got a degree in finance. I'm stepping out of secondary, going into loan origination, and come meet George and Janet Moore and come find out what this is all about.
Okay. So those are the people that got you involved in the mortgage business.
Yes.
Shame them.
Shame them. They told me it was all golfing and going to dinner and having a good time.
Yeah.
In the beginning, that kind of was that way.
Yeah. The old days of the mortgage industry.
The old days.
So a lot has changed since then.
A lot.
Everybody knows we had this big crisis, another crisis, about 12 years ago, the mortgage lending crisis and the meltdown that everyone kind of refers back to. 5 years from now, we'll be referring back to the COVID-19 crisis, but the one that you and I remember explicitly is the mortgage crisis of 2008. Why did that happen, in your opinion? I've heard speculation, and being in the financial business, there was an analyst who really didn't compute that prices could drop below zero from a pricing point of view.
So from a real estate investment perspective, no one ever thought that the price of your house would go down. They forgot that prices of houses go up and down. But there was a whole lot more to it than that. There was excess capital going back to 2000 from when they were concerned about the Y2K. And so that excess capital remained in the market through the tech bubble, and then it continued. And then when the tech bubble popped, the money shifted to mortgages, and it went crazy.
I'm sorry, my producer over here is telling me, am I looking like a slouchy old man?
Sure got a little bunched up.
Bunched up? It's because my back is killing me. It's crazy. Sorry, I
That's
threw
okay.
us off. Sorry, audience. You'll get to see old man sitting in the director chair over here. It sucks. I digress, please.
So there was too much money flowing around, and so everything kind of went crazy. It's difficult to talk about because in some instances,
It's like an onion, many, many layers.
yeah, many layers, because people weren't being played favorites to deliver loans into the secondary market. So one lender might have a higher price than another lender, which started people to go around going through Fannie Mae and Freddie Mac.
Can I stop you there?
Yeah.
What is the secondary market for those that
Great.
are like, what does that mean?
What that means is, so everyone in Virginia Beach wants to buy a house. Okay? All the banks in Virginia Beach do not have enough capital in the banks to lend to everyone to buy a house.
Okay.
So we borrow money from other parts of the country or other parts of the world in order to facilitate the lending of those transactions.
Okay, tracking with you.
So that's why we have a secondary market. So a bank originates a loan. A bank will decide to either hold it for the life of the loan or sell it for cash. And that's what most people do.
So I was taught in economics there's this kind of velocity of money.
Yes.
And you have this Fed Reserve
Yes.
who's lending money to the local bank overnight through go ahead.
Yeah,
Help
but
me.
remember back in the day, it was taboo if you had to go to the window.
Ah.
You were not supposed to go to the window, or you weren't operating properly, and you were going to see a regulator come talk to you.
This is what you get in live podcasts. We have these cool pictures on them, and man. So much like the mortgage crisis,
Yes.
things collapsed, things fell.
Yeah.
So go ahead with that thought. We'll keep rolling here, and we'll have a guy fix that.
So as everything started getting more crazy, it was the point in the beginning. At one point, I used to tell people, if you could fog a glass over the phone, you could get a loan.
Yeah. Yeah.
Not anymore. We're back to proper standards of, hey, you got to show us, A, who are you? Do you have the capacity to pay for a loan? Do you have a job? Do you have income? Are you self-employed? Do you write off all of your income and actually don't have enough income?
Guilty. Yeah.
We have to look at all of that in order to make sure that you qualify to make the payments. And there's so many people involved in the process, people forget there's people involved in the process. There's a person who's going to look at your documents and say, this person qualifies because they have shown me the documentation that says that they qualify.
And so those lenders, even in that secondary market, they're probably putting a guideline on the local lender to say, follow our guidelines.
That's right.
Or you may not be able to lend anymore, or you may not be able to fund your loan if you didn't check these boxes.
If you don't check all the boxes, your loan will not be purchased. And then you're stuck with a loan on your books, and nobody wants that.
Yep. So the local bank, let's say Town Bank, they've got a limited amount of resources based on the deposits of
Right.
all of their banking customers.
Right.
Okay. So those banking customers provide a certain amount of liquidity to the bank to lend out to
Right.
other people.
Yep.
Once they reach that capacity, they have to go to the secondary market.
We sell those loans off to
Okay.
replenish our capital.
Okay. Makes sense. Thanks
Yeah.
for defining that. So, 2008, what happened?
So, 2008, the Federal Reserve finally decided that they were going to start raising rates because they were concerned with inflation. And that essentially put a short squeeze on all of the loans that had been, I shouldn't say all of loans, a lot of the loans that had been written that were of a riskier category. Payment option arms. In other words, you could make an interest-only payment. You could make just an interest payment. You could make just a principal payment. You could make a partial payment.
Like the negative AM loans, negative amortization.
Yeah, and they would negatively amortize.
Yeah.
And
Which means the balance of the interest that you deferred or hadn't paid was being added back into the balance.
well, what was even crazier is that so they would say, here's a 30-year amortization loan, and you can make all these payment options you want, but the entire loan is due in 5, 7, or 10 years.
Holy cow.
Yeah. And so let's say that you were dealing with some credit issues and you didn't have those fixed before you wanted to buy the house, and you could take one of these riskier products with the assumption that you would fix your credit and get you back on path and then come in and refinance out of it. Well, when the market turned, prices dropped, you couldn't refinance out of it, there's no liquidity.
Wow. We were talking last week. This phenomenon that happened in 2008 eerily is maybe creeping up again, but it's a little different now than what it was. Can you talk to that, speak to that?
So from that perspective, I really don't think we're going to see anything like 2008.
Okay.
We have been underwriting loans so soundly for so long that it will take a huge shock to the economy, which is why we're seeing all the stimulus right now to try and make sure people can make their payments or give them a forbearance.
Yeah, it's not the consumer's fault what happened here. The federal government
It is not the consumer's fault.
implemented a system that shut down our economy.
Right.
So, the people out there who are struggling right now, no shame.
None. None.
Take the shame off.
Yep.
You're in a position you're in because the federal government, in its wisdom, right, wrong, and different, made some decisions that has affected all of us equally. So what do you see in terms of the strength of lending and consumers who may be thinking about refinancing or purchasing today? What do you see happening?
So it's kind of unfair. Anyone who is an essential worker and has a job is fine. They're not worried. Their income's not in jeopardy, and so they qualify. But you have your restaurateur, you have your people that work in the restaurant, you have all the industries that have been shut down, then you have a problem.
Yeah. I was listening to a Joe Rogan podcast, and he had a steakhouse entrepreneur out in Los Angeles.
Yeah.
And it was really, really sad listening to this guy's story and what he's trying to do to stay open. And a really nice, posh restaurant, I think it's in West Hollywood. And this guy's just
Serving meals on the sidewalk.
right,
Yeah.
and trying to serve the first responders and
Yep.
the emergency medical professionals and just anything you can do to stay alive. And so, one of the things I'd say to our listeners out there and our viewers is support the local businessmen, support the local economy.
Yep.
In Virginia, hey, get out there and buy some stuff. This feels like, in some ways, what back in the Great Depression, the way you got the economy moving again was go buy.
Spending money.
Spend the money. Take the stimulus check you've been given and reasonably put it back into the economy to keep the economy moving, to keep small business moving.
Well, you remember, that was George Bush in 2001. It's like, get out there and be a consumer. Don't
Yeah.
stop living.
Yeah.
This whole COVID thing has stopped that,
Right.
which is that's the different part about that.
So, if I can, let's redirect this conversation a little bit to this this borrower that you were talking to me off film here. and really just wanting to be able to ask you questions, but felt maybe a little embarrassed to show some chinks in the armor that they didn't have all the answers.
Yeah.
So can I just break down maybe some lingo in the business?
Yeah.
You had a great definition for interest rates. I said, okay, Bobby, what's an interest rate as it relates to mortgage? So define that for us.
So it's the cost of capital for someone to provide you with the ability to go purchase that house over 30 years.
The cost of capital.
That's their risk-adjusted return on their investment in your
cost
purchase.
of capital, cost of money.
Yeah.
That's the factor that you're going to pay for the principal amount of money that you want to borrow.
Yes.
Okay. So that interest rate then is tied to a term or a period of time.
Yes.
Most mortgages can be bought in what terms?
Most are 30 years.
Okay.
We see some 15 years. Sometimes ARMs are more attractive, but right now...
And an ARM is defined as?
A great adjustable rate mortgage. See, the mortgage alphabet soup. I get lost in it myself. I just start going to my acronyms. So an adjustable rate mortgage would be where you have terms that are adjusting based on an index and a set of caps.
And how often can those rates adjust?
It depends. Depends on the ARM that you buy or you use. So
it could be a 1 year, 3 year, 5 year, 1 month.
Right. Most are adjusting annually.
Okay.
And they have a cap that sets a bottom, so it can go no more than 1% down or 1% up, and then it can go no more than 5% up or down over the life of the loan.
Okay. So hence adjustable
rate.
The rate can adjust down if rates drop, but it can also adjust up if
that's right.
Rates go if and when rates do go back up.
Yeah.
Does your tea leaves tell you when rates are going to go back up? You know, as of 2020, we're in May right now. So when are rates going up, Bobby?
So there are times in the market when you're just left with, you need to look at the market every day. And that's where we're at right now. In order to really forecast what's going on out there, it's very difficult. If you look at the base price of a mortgage-backed security, you would say rates should be much better than they are, but they're not. So,
and what do you think's driving that?
What's driving that is the backside, the servicing side. Lenders don't know whether or not they're going to receive payments from the borrower, and in some contracts, that loan servicer must forward the principal and interest payment to the person who put the capital up for that loan, regardless of whether or not it was received.
Okay.
And if you have to make someone's mortgage payment for 6 months, maybe 12 months, as a servicing company, you've got a real hard thing to do if you can stay afloat.
Okay. So we could spend a whole podcast just on that conversation. So we'll have you back another day and we'll deep dive a lot of this stuff. But in the sake of time, so we've got interest rate, we've got adjustable rate mortgage, we've got a term. 30 years the most popular term.
Yes.
You could have a 15-year, you could have a 10-year.
You could.
Amortization.
So we see ARMs and 15 years come into play when the yield curve is very steep.
Yield curve.
So Fed funds is at what? 0.25% right now?
Okay.
0 to a quarter?
Yeah.
And a 30-year mortgage is, let's say, 3%. And a U.S. Treasury is somewhere under that.
Okay.
As mortgage rates and treasuries, 30-year treasuries go up to 5 or 6%, and we're still down at 1%, you see the steepening of the curve.
Okay.
So you'll see rates much higher on the 30-year fixed, and you'll get a better price at a 15 or an adjustable rate mortgage. And that's when sometimes 15-year loans make a lot more sense than a 30-year.
Okay. And that again goes back into, if we're looking at it from a personal macroeconomic point of view, whether a person chooses a 30-year, 15-year should probably be looked at macroeconomically like their cash flow, right?
Yeah.
What do they want to do with the difference in those payments, the difference between a 30-year and a 15-year,
right?
As an example.
Yes.
Yeah.
So in most cases, I recommend people take the longer term. have the smaller payment out of their budget, so they have more money to free up for opportunities to get out of the rat race, to make investments, to get to the investment side of the world.
We would refer to that in the investment world like the delta or the arbitrage, your cost of money, the interest rate,
Yep.
to what your perceived rate of return could be with the difference.
What would
in,
you do with that money?
Yeah.
Yeah.
So if it's going back into your cash flow just to buy vacations and run up consumer debt, probably not a good thing.
No,
Let me just be more blunt. Not a good thing.
not a good thing.
But if you're taking that difference and looking for opportunity to outperform your cost of money, that's a risk-adjusted analysis that a person has to do with their advisor.
So if you take that difference usually, and you say you wanted to pay your loan off in 15 years, and you took that difference and you invested it over 15 years,
Yeah.
you get to the point at 15 years where you have this epiphany. You typically have enough money to go ahead and pay off the mortgage.
Mortgage Freedom Day.
Mortgage Freedom Day, right. But then you realize, wait a minute, why would I do that?
Yeah.
I can afford this. I go get another 30-year loan, and then I keep doing the same thing, and I keep growing my principal over to the point where
Yeah.
I could
Kind of
pay.
like what public corporations do. Instead of holding the debt over a short term, if they can extend that debt over long periods of time and outperform the cost of money,
Yes, that's exactly right.
they have the opportunity to put that capital back in innovation. Kind of like I think what Apple Computer did that when they issued debt in the form of bonds. Instead of giving up all of their cash to pay a dividend or return of premium back to their shareholders or stakeholders, they issued bonds or debt
Right.
and felt that they could outperform that
The
cost
cost of the
of
debt,
money.
and they
on the
did.
debt. Yeah,
Clearly.
in a big way, right?
Big way.
Yeah, go Apple.
Yeah.
All right, so getting a good handle on interest rates on term, there's these other two things when we're looking at the HUD statement or that truth in lending statement from the old days. What that's called what now?
We call that now the closing disclosure.
The closing disclosure statement.
So it's you get the loan estimate first, and then at closing you get the closing disclosure.
So loan estimates when the person meets you for the first time and they're like, Bobby, give me some breakdown on what could be possible.
Almost.
All right, help us.
So when a customer first comes in, we take in all their information, and they typically don't have a property. Until you have a property, we are not required to give you a loan estimate because we can't tell you exactly what the taxes are going to be on that property.
That's for a purchase. How about
That's
a
for a
refinance?
purchase.
They've got a property.
A refinance, we got to tell you immediately, and you will get a loan estimate immediately.
Okay. So a refinance, they would get a loan estimate immediately. A purchase is this universe of the unknown until they identify a property.
Until you're under contract.
Under contract, and does an appraisal matter?
That comes in after the fact.
Okay.
So we still assume that everyone in the process has marketed the property properly, so they have an idea of what it should appraise for because they've done a comparative market analysis.
Okay.
They've put the house on the market. Buyers come in, they bid it up or bid it down, and everybody comes to a price. Then you're under contract. Most cases after that, you have a home inspection, and then you order the appraisal.
Okay.
And then the appraisal says it either fits or it doesn't. And there were times when appraisers, if you had a house for sale for $330 and you had a contract for $330, they wouldn't bat an eye to try and deliver an appraisal at $350.
Okay.
Today, if your contract price is $330, they are not stretching. They are not trying to find you extra value. They will find the comps that make it work, and they're done.
So you nor the borrower can manipulate the appraisal.
No,
You could go to jail for that,
you
I
can
would
go
assume.
to jail
right?
for that. Yeah.
So the appraisal has to be a standalone.
It's a standalone entity. It's a.
You can't pick it. The consumer can't pick their appraiser.
No.
Well, what if I just want to have my house appraised? What
You
if
can
I-
call an appraiser and get an appraisal,
Okay.
but that's not going to be used in your loan file.
The lender is not going to use my appraisal. Okay. They want their own independent appraisal.
Yeah.
All right. Can appraisals be different based on who I borrow money from?
Shouldn't be. They shouldn't be.
We hear it.
You hear that, but so here's the thing. You borrow money from a lender who's out of the area, and they hire a contract company who's regional but not local. So a guy drives down from Richmond and doesn't know our market area and doesn't appraise the property properly.
Okay, makes sense. So we get through this appraisal. We get a value of our property either from a refinance or a purchase point of view. I know my interest rate is a cost. I know an appraisal fee is going to be a cost, and probably a cost for the credit report and all that.
Yes.
But if we get into the pricing of a loan, outside of the interest rate, there's these terms called discount and origination.
Yeah.
Help our audience understand a little bit about those terms.
So you should try to think of loan origination and loan discount as a fee that will be used to lower your mortgage payment, lower
Okay.
your interest rate. There are a lot of lenders that charge an origination charge. We charge an origination charge. It's just a flat charge that we charge in order to process and close your transaction. Process, underwrite, and close.
So kind of like a flat fee.
It's a flat fee.
Okay.
Yep.
But there could be an origination on top of the flat fee?
At that point, it really turns into a discount point.
Okay.
And that's where you should hope that anything you pay to the lender outside of a third-party service is used to lower your interest rate.
Okay.
Most lenders have some level of processing, underwriting, and doc prep, or whatever you want to call it, but they have a charge for that, and that typically falls into the origination bucket.
So in the bond market, you're talking about it as a premium, par, and discount. Is that similar in the mortgage origination world?
Yes. So if in the bond market or mortgage-backed securities market, you're looking to price a loan, if the market price that day has no points is 3.5%, and you want 3.25, but maybe 3.25 costs you a point. So $3,000 on a $300,000 loan. Where if
Okay.
you went to 3.25, you might get a point back. That we call lender credit.
Okay. What's best? What should a consumer do?
Depends on
Loaded question, right?
Yeah,
I
it
got you,
depends
but-
on a consumer's situation.
Yeah.
If a consumer has a contract where their agent, if they're working with a good agent, that agent has negotiated into their sales price of the purchase price of that house closing cost assistance. Now, closing cost assistance are limited based on the loan programs you're using, so you want to make sure you work with your lender to make sure what your limits are with the product you're using to what you should even be asking for.
Yeah. Well, let me put it to you this way. I know in the other hat that I wear in my financial practice, to assume that someone's not looking for what's in their best interest in terms of shopping or being competitive in the marketplace. You obviously have a relationship with ongoing clients that you've had relationships going all the way back to 1996.
Yeah.
But if someone new is coming to you, or maybe in a referral, or maybe through some marketing efforts that you and Coastal and Town have done, when they're trying to price you and building this trust bridge, when they're pricing a loan, what should they be looking at to kind of establish par or putting everyone in an apples to apples comparison?
First, loan program for loan program, and then start with what is the rate that costs me nothing in discount points.
Loan program to loan program. Help me understand that.
If you're looking at a conventional 30-year fixed versus a 15-year fixed, those are two different products.
Conventional to non-conventional. What does that mean?
Conventional, non-conventional would typically mean over-conforming loan limits, and the prices on those are going to
All
be
right,
higher.
man, you're killing me here.
Sorry.
Over-conforming loan. People out there are going, what the
500
hell are y'all
for
talking
our
about?
area. 510,400 is our conforming
And that's
limit
different in
different
other regions of the country?
all over the country.
Okay. California as an example. Yeah, I'm just pulling that state out.
Much higher.
All right.
Yeah.
So here in Virginia, conforming loan limits,
510,400.
510, 400. Does it matter whether it's 30-year, 15-year?
That part doesn't matter.
That doesn't matter.
No.
Okay. All right. So conforming loan, and then you have these backers of loans, I guess, FHA,
VA,
VA Veterans Administration. FHA is acronym.
Federal Housing
Federal
Administration.
Housing Administration.
HUD,
Housing of Urban Development. Did I get that one right?
Housing and Urban Development.
Okay. And then new home buyers have like VHDA?
State of Virginia has a housing authority, Virginia Housing Development Authority.
Okay. So there's lots of different choices. So what you're saying then is that as a borrower, if they're going to compare apples to apples, they've got to compare VHDA to VHDA, VA to VA,
Yes.
FHA to FHA, conforming to conforming,
Yes.
non-conforming to
non-conforming.
Ah,
And then terms, how long they're looking at the loan, for 30 years or 15 years, or a 5-year balloon, for example, possibly.
okay. And then we're back to that interest rate and the discount factors, the origination factors.
Right.
Those all come into play.
So origination charge should be baked into that equation as well.
Okay.
So one lender might say our origination charge is $1,000, and one might say it's $500, but maybe their par rate is 1/8 of a percent more.
Why would my APR be different than my interest rate? APR, again, annual percentage rate.
Annual percentage rate. It was designed originally to help a consumer identify if there were items in their financing that were more than they were anticipating.
Okay.
And so the higher...
What's an example of that? What would
So the larger the spread between your note rate and your annual percentage rate, the more you should go look at your loan estimate at this point and look for charges that you might be paying for that you didn't think you were, such as discount points.
Okay. Awesome. So that's important. Will they see that in their estimate?
Very clearly.
Okay.
Yeah.
So it's fully disclosed.
Completely disclosed. The new disclosure is beautiful from the standpoint of it says, will this loan balloon? Yes or no. Does this loan have a prepayment penalty? Yes or no. It's very clear as you go down the page.
Okay. So full disclosure is something that the industry as a whole is required to operate in. Are there little small? My mom used to say, "Kenny, the large print giveth, and the small print taketh away." What do we need to look for in the small print?
So the small print.
Ben, am I putting you on the spot here today?
Well, so the small print, the new disclosure. The thing
You're on the
with-
hot seat now, Bobby.
So what you should think about as a consumer is this: what is the cash out of my pocket? Is this loan affordable? Does it fit my comfort level? Am I comfortable making this payment? And there are ways to figure that out. But then it's the cash coming out of my pocket. And then if the APR is high, but I have maximum seller concessions and the seller is paying those costs.
Maximum seller concession.
So, for example, an FHA loan will allow a seller to contribute 6% of the sales price towards the closing costs.
Okay.
VA is 4% towards prepaids and debt reduction, and all reasonable closing costs,
Prepaids.
taxes and insurance,
Okay.
and the loan guarantee fee. They could pay the loan guarantee fee up front.
And loan guarantee, like with VA, there's a loan guarantee.
That's
fee.
the insurance component of a VA loan.
Okay.
If a veteran has a 10% or greater service-connected disability rating, they don't have to pay that.
That gets waived.
That gets waived.
All right. Tracking with you. So it's important then to look at that estimate.
Look at that estimate from the standpoint of if the APR is higher than the note rate significantly, is that coming out of my pocket?
Yeah.
If it's not coming out of my pocket and it's being paid by the seller concessions, I shouldn't care about it.
Okay. Are there any other fees? So when we're looking at that good faith estimate and then finally we get to closing and you have this HUD statement that's required for all loans.
The closing disclosure now.
The closing disclosure. Thank you for correcting me. Until I'm old school.
Yeah.
So, and we'll come back to that in a minute. Remind me to talk to you about Dodd-Frank and RESPA, the Real Estate Settlement Procedures Act. Not that we want a whole class on that today,
Right.
but just enough to inform at a black box dive level we'll have you back another day to
That's
carry
a
this conversation.
whole another can of worms.
Yeah, maybe we'll have a regulator in here one day to
That would be
grill those dudes,
fantastic.
put them on the hot seat.
I'm
right?
sure we can get one.
Yeah, hey, I'm all for it. Let's do it.
Okay.
And anything that can help the consumer be more informed,
Is better.
better. It builds a trust bridge with
Yeah.
those of us in the advisor capacity, that if they really have all the information and they know that you're working and I'm working in their best interest, that's a good day. And then it exposes where you have weaknesses, and who wouldn't want to know where their weaknesses, where their blind spots are at, and from the consumer point of view and from the advisor point of view.
Yep.
And everyone has weaknesses, and so I think it's important that we put that out there and just go, hey, as a lender, if you have another guy that you're competing against and they just keep beating you on every deal, that means you have a weakness somewhere. Wouldn't you want to know where your weakness is at? And wouldn't your bank want to know where its weakness is at? So I'm all about let's find out our weakness and let's expose those, and then let's expose the strength. The consumer gets to see that, they get to benefit from that, and it's a win-win at the end of the day. So in this world of fees, and we're looking at this HUD statement, what can a person expect to pay? Like there's title insurance, and that's an old English word, right? So you go back to title, the king, and I'm going to go on a little bit of a soapbox here.
Go for it.
In Virginia, we're still a good old commonwealth.
Mm-hmm.
So going back to old English law, you have a governor, and you have these mayors, and you have these nobles at the local municipality level. We have to pay homage to those in the form of taxation.
Yes.
So property tax is one of those things that comes up in a HUD statement, right?
Yes.
Title insurance. When a person pays, so we know we got to pay taxes. We can't avoid the taxation. But the title insurance, can we avoid paying title insurance?
You can avoid paying owner's title, but you cannot avoid paying lender's title.
Can I avoid paying owner's title insurance on a purchase, first purchase?
You can avoid it, but I don't recommend it.
And why?
Well, if it's so important that the lender has title insurance to the point that they're going to make the buyer pay for it, you should think that you would possibly want to have title insurance yourself.
All right. Let me back you up there. The lender is going to force me to pay their title premium.
That's correct.
Why is that?
Because they want protection to know that the property they've lent on is free and clear of liens and judgments.
So if you want their money, they're going to go, hey, a cost of having our money is to pay this title premium one time, or is it an ongoing?
One time.
Okay.
And it's to ensure that it's not only just to insure the lender, but it also is ensuring you that you're buying a property that's free and clear.
Okay.
So real life example, property that a friend and I were looking at over on Shore Drive at one point. We didn't buy it, thankfully. The poor person who did buy that property ended up discovering a $100,000 lien in Norfolk.
Ouch.
I don't think he bought owner's title.
Okay.
The lender's title, I think, had to come in and save him. But what happened was the lien was filed in Norfolk, but not Virginia Beach. And when they did the title search, they didn't search the federal court records in Norfolk.
And when you say they, who's they? That's
Whoever
doing the title insurance?
whoever did that title search
the
and provided
law firm or the title company.
whoever did that, and that person didn't elect to buy their own title policy, so they were kind of out there until the lender's policy stepped in and cured it.
Do you know how title insurance is priced?
Very, very, very reasonably.
Okay.
Yeah.
So the title insurance is a one-time premium you pay to an insurance company?
Yeah.
All right. And it's like a risk premium?
Yes. So here's the other flip side to that. I'm at dinner with a bunch of nurses that meet a couple times a year, and one of the guys goes, "I got sued and made money. You want to know how?" And of course, I'm like, well, of course, you know.
He got sued and made money.
Got sued
All right.
and he made money, right?
All right.
So how does that happen? So he bought a house.
Is that a repeatable process? Can you do that over and over again?
I think that was luck.
Yeah.
That was just silly luck. So he bought a house, and when he bought the house had a mechanic's lien on it. and he paid a premium insurance policy to write over the cost of that lien.
Okay.
He sold the house. The next guy bought a premium title policy and insured over it. The third guy buying the house did not. He would not and wouldn't buy the house unless someone cleared this lien. Well, my friend went out and found
When you say clear the lien, like pay off the lien
the
holder.
debt. So it was a $60,000 roof lien.
Ouch.
Right. Nice big house, big contract on a roof. And so he went and found the contractor, paid the contractor a small fee for the cost of that lien, a discount basically saying, hey, you haven't been paid in 15 years. Do you want some money to release this and not have to fuss with it anymore? Person said yes. He wrote him a check, went back to the title company and said, if you want to clear this, you have to pay me now. I'm the no owner of this lien.
Okay.
That's how he made money.
So what you're saying to me then?
Very rare. I mean, it never happens. But that's just another example of title insurance protects you throughout the entire lifespan of that property.
So it's a risk premium in your opinion. It's worth writing a check for.
Yeah, it's worth the check.
Yeah. Otherwise, you could potentially be writing that check out of your assets,
So
your other assets.
Yes. Think of it this way. If something does go wrong with the chain of title and everybody starts to sue everybody, guess who they go after first? The person without the title policy because they don't have legal representation to fight it.
Yeah. So they're extremely exposed.
Extremely exposed.
It reminds me, and we may have to fact check this, guys, but there was a gentleman in Virginia Beach years ago that
Yes, there was.
was going around.
Buying easements on properties.
Yeah.
Yeah.
I need to look that up. That'll be a fun episode. Maybe we can get that guy in here and have a conversation with him. I don't remember anything more than that,
I
but
think he retired.
he retired. Either that or he was retired, right? He's at the bottom of the Chesapeake Bay.
No,
somewhere.
I think
No,
he
lived?
just I think he just sort of rode off into the sunset.
Wow. But the guy made money doing this, I guess.
I think he did actually.
That's nuts. We need to check that. So, hey, Zach, you know what's on your
Homework
on your
list.
homework list? And Zach's not even paying attention right now. He's just so. Oh, you're researching right now. Okay. All right. Cool. So, Bobby, as we go through this, I brought up to you a little while ago, just as an education point of view, there was this 2008, and going back to that for a few minutes, and then we're going to try to correlate that to where we are now in 2020. But there was this Dodd-Frank and RESPA, the Real Estate Settlement Procedures Act, that was changed and kind of reformed under Dodd-Frank, these two senators. What did that act do, and how has that changed the mortgage industry today?
It put teeth into RESPA.
Okay.
Forever, everyone abused RESPA like it was somebody's stepchild that no one cared about and just was pushed off into the corner. Dodd-Frank actually did some good things. It provided teeth for people to go and proceed legally. Unfortunately, I think we saw a lot in the news that it also got abused from the other side. But all in all, I do think it did a really good thing in providing better disclosures to the consumer. Some would say it's just different. I think it's a little clearer.
Okay.
The HUD-1 statement was beautiful. It was one piece of paper. You could go down it and figure it out. You got to flip pages back and forth on the closing disclosure, but it does all add up. And it has the verbiage you need at the spots you need it to understand what that item means, which is helpful.
So I know this is probably more of a real estate agent question than it is a mortgage broker question, but your personal opinion, not holding your feet to the fire here, but a lot of times in purchases today, you'll see consumers buy these home warranties that are added to the policies. Beneficial, not beneficial, good, bad, indifferent. You see it a lot of times as a selling.
Sometimes it's a selling
benefit.
feature
Yeah.
because you've got an older home and you recognize the HVAC system is 15 years old.
Yeah.
You're not going to be required to necessarily replace that on a home inspection or an appraisal. And so you offer a carrot to the consumer. Hey, if you buy this house, I'll make sure that you don't have an issue with a cost perspective for at least 12 months.
So it could be beneficial for
It could be.
the right buyer.
For the right buyer, it's a great tool.
Yeah. especially if you don't have a lot of assets.
And you don't have a lot of assets. If
Okay.
you're buying new construction, I don't know that I would necessarily do that.
New construction, the builder has an obligation for how long? Usually about a year?
At least a year.
At least a year usually. And a good builder will
Stand behind
stand
their
on their
product.
reputation, right?
Yeah.
Right. Makes sense. So you know what? We're coming up on the close of this today. We got a few more minutes. If people want to talk to you in Virginia, where are you specifically licensed? Who can you help? And in what regions can you help consumers?
Virginia and North Carolina.
Okay, Virginia
Yeah.
and North Carolina.
Yep.
So from a mortgage broker, banker point of view, where the lender's licensed is important, and
Yes.
then where you, the individual mortgage representative, is licensed, that's also important.
Yeah. I mean, so you can be licensed in all 50 states if you want, but you want to work with someone who, even though you may not want to shake their hand right now, that you could go sit in front of them at their desk and shake their hand.
And by the way, we're still practicing this.
We've
this
got social
6
distancing
foot
here. Yeah.
So, what are you seeing in the local market in terms of local market, and then obviously we've got listeners outside of the state of Virginia and North Carolina. Give me your tea leaves on where you see the market from the rest of 2020 and maybe beyond.
So we're a different market, right? We're not the typical market across the country
Because of our military.
because of our
Yeah.
military. And so we have a lot of demand going on right now. I've got people coming from Hawaii and San Diego buying houses. And Northern California buying houses in Suffolk. So I got people coming from all across the country to Hampton Roads.
Not going to hold you to this, but reading the Wall Street Journal daily and listening to experts across the land, some talk about a V-shaped recovery, some talk about a W, I saw yesterday the new term now is swoosh, go Nike. Where do you see, from a mortgage perspective and from a borrower's perspective, do you think we're going to see some improvement towards the rest of 2020?
I think we're going to see sort of stability.
Okay.
I think the Fed has figured out how to keep rates reasonable and to take some of the volatility back out of the market. When the Fed came out on a Sunday, 6 weeks ago, and said we're dropping rates, that sent the market into a panic. And the mortgage-backed security market went up and down several points for about a week and a half until it finally settled out and is about where it was at its peak just before everything went crazy. So that part's good. So I think a consumer is going to find fair rates for the next 6 to 12 months. They're going to find opportunities that are going to be micro opportunities. They're going to, when your lender calls, pick up the phone because they're telling you now is the time to pull the trigger.
Nice.
2 weeks ago, VA refinance was very low, paying 1% back. The very next Monday, it was costing a point. And what we're seeing there is that it's not necessarily the price changed or the investor's price hurdles changed or their metrics changed. What changed was their ability to process the transactions, and they had to cut off production.
Yeah, we were talking about that last week. So we're now May 2020.
Yeah.
What are you seeing today? And somebody might listen to this podcast a year from now. So for May 2020, how long is it taking on average to close a purchase, and how long is it taking to close a refinance?
So if outside of COVID, if the borrower's been properly pre-approved and all their documents are in the file, you can close a loan in 20 days.
20 days.
Without a problem. There are lenders out there that say we do it
Wow.
in 7, but that's really a fire drill.
Okay.
That's not comfortable for anyone.
Yeah.
That means somebody dropped the ball and you're picking it up for them because you didn't close on time somewhere else, in my opinion.
Tracking. All right.
Tracking. But refinance, 20 to 30 days. You should be able to do that. And it's basically really all on the person's ability to get you the documents they need to process their transaction.
If you're a new home buyer and you're just new to this game, you're a young individual or maybe even an older individual who's never purchased a home before, what's the steps and processes a person should go through to get pre-approved?
The first thing is to know yourself. Get
Okay.
your ducks in a row. A lender has to know, who are you? We have to lend to that person. So we need to know who you are. We need to know that your identification matches your bank statements, your pay stubs, your W-2s. When you've moved around a lot, it's okay, but you need to write letters of explanation showing I lived here and that's what my W-2 says this, and this is what my credit report says this address. You have to just get your ducks in a row.
Yeah.
You got to learn online banking. You need to be able to hand your lender a PDF of your bank statement, and you should practice safe use of your documents. Try not to email them. Learn how to go online and go to the website and upload your documents directly to the lender's website.
So that's usually encrypted.
And it's encrypted and
Protected,
secured.
okay.
Yeah.
All right. Makes sense. Do you encourage people to get like credit protection, freezing or locking up their credit like you'll hear some folks talk about?
If you have been a victim of credit theft, then yes. Otherwise, I suggest that you just stay on top of your credit. Go to annualcreditreport.com. It's the only free location to get a copy of your credit report.
Annualcreditreport.com. Okay.
Pull it every 4 months. So we're in Virginia. Pull Equifax, and then pull TransUnion, and then pull Experian.
Those are the three major
credit reporting agencies. If you see a problem, pull all three immediately.
When I go to borrow money, do you guys charge me, the lenders, do you charge me for that credit report?
It gets charged to you, but in most cases, you're not going to have anyone ask you for a charge to pay for your credit report up front.
Okay. So at the end of closing, that's one of those line items.
That's one of those line items.
What does that usually cost?
About $20.
Okay.
Yeah.
And an appraisal typically costs what?
Appraisals, I mean,
I know it ranges from state to state.
yeah, but you
region to
can't
region.
believe what a value an appraisal is. When I got into this business, appraisals cost $400. Guess what they cost today? $400 to $550.
Those guys are hating life.
They are.
Inflation?
Not seeing any inflation.
Wow.
Yeah. Now,
Why has that
That's-
price not gone up?
well, so that's the price of the appraisal. Okay. That doesn't mean that not necessarily what a consumer is going to end up paying. They might end up paying for an appraisal management service, another fee of $150 to $200, where a lender,
Appraisal management service. So you'll see that on the HUD.
yeah,
Okay.
or it might just be rolled into the cost of the appraisal by the lender. And
Okay.
so it's a cost to obtain it. So a lender might use a third-party vendor to make sure that they're in compliance with not having any communication with the appraisal company.
So that appraisal management company is like the hired gun to give that level of handing off
Yeah.
that responsibility.
Gives
where-
that distance.
distance. Yeah, makes sense. All right. Man, there is so much we could talk about today. We're coming up on closing this out. We've got about 10 minutes left, but
God, yeah,
and we're
got this long.
I beat you.
No, you beat me.
Cheers. Maybe I need a refill. But I'd love to have you back at another day, and we can deep dive this some more. Hopefully this was value to our listeners. It was for me. I learned a lot today, so thank you. And I'd love to get you back on the show at a later date, and maybe we'll bring in a regulator if we can find one that wants to talk to us.
I think I can find one.
Really? All right.
Yeah,
That would be cool.
I would imagine we could probably find one through a mortgage insurance company.
Okay.
Yep.
Let's do that. That would be fun just to deep dive that, and really from the spirit of our show and deep diving the black box. And, and when you think about this black box, my mind's eye goes to, unfortunately, when a plane goes down, when a crash happens, when you listen to the media and you listen to all the experts, the first thing they talk about is the black box.
Yep.
Finding the details of what really happened.
Yeah.
You get eyewitness reports, you get these outside opinions of what they think happened, but no
what was
one
mechanically happening with
Yeah.
the plane.
So
Yeah.
that tells the entire story. And so in the spirit of our video podcast, what we want to do is deep dive and tell the rest of the story and really give our listeners an opportunity to get educated and have full disclosure. And one of the things we're going to do in the future, just so you're aware, is we're going to have a master class of our own where we're going to give you an opportunity to actually show some different scenarios and show some graphics and some charts and allow consumers to tiptoe through the process as if it was really them, to be able to make really good financial decisions, not only today, but over their lifetime. So I'd love to have you back to
That
do
sounds
that.
fun.
Hey, thanks so much for joining us today. We hope you enjoyed this session, this podcast, and we look forward to having you back on the show soon.
Looking forward to it.
You know what?
What?
I almost forgot, man. How can people reach you? We'll put that on our website. But if you're in Virginia, North Carolina,
If you're in Virginia, North Carolina, you can reach me at choosebobby.com. That's my vanity URL. It's a
How
lot
cool is that?
easier to
Choose
remember than HTTP : and all that fun stuff. www.choosebobby.com takes you to the bank secured website at Coastal Town Mortgage, and that's how you can reach me immediately.
and so if anybody's listening who's in Virginia or in North Carolina, Bobby is a guy I trust. Bobby's a guy and I've got a number of mortgage lender brokers that I work with, but Bobby's one of those at a high level that has always been transparent to my clients and my financial firm.
Thank you.
So thanks for taking care of my clients and customers. We appreciate that, and I know they do too.
All right.
You're a cool dude, man.
Thank you.
It's cool hanging out with you today. Thanks
Pleasure.
for spending this time with us.
Look forward to a lot more of this. This is fun.
All right. Hey,
Yeah.
have a great one.
You too. Thanks. Cheers.
Cheers.